What is Parkinson's law?
C. Northcote Parkinson's, right? Work expands to meet the time envelope allowed.
Mm-hmm.
And of course, that's right. You give an assignment, a homework assignment. It's due on Friday. Well, all the work gets done late Thursday.
Right.
Is that the way you did it?
I mean, unless it can be turned in Monday. Yes, absolutely.
That's the way I did it. A luxury once enjoyed becomes a necessity. And, I grew up around cars, right? So at one time, cars didn't come with air conditioning. I mean, even when I was growing up, most of them did.
Mm-hmm.
I was growing up through the changeover where, it was, okay.
Long time ago.
Yeah. It was a long time ago, but not that long. See, but cars didn't come without air conditioning. If you think about it today, you couldn't give one of those cars away if it didn't have air conditioning. You couldn't give it away unless you were in Canada. I mean, it ain't going to fly in Texas, California.
No, absolutely not.
And so, two, as an example, I rent cars from time to time. I rented a car probably 3 or 4 years ago, and it had a backup camera. Man, it's the greatest thing since sliced pie.
Mm-hmm.
Well, now you get in a car and it's like, where's the backup camera?
Right.
And then Nelson talks about, I've heard him mention a lot how, the seat warmers in a car. Well, now the seats come air conditioned. I mean,
we get used to a lot of the luxuries in life. And then once a luxury enjoyed, then it's a necessity. You got to have it.
Yeah, you just put a little cream in your coffee, right? And then, okay. Expenses rise to meet income. That's Parkinson's law. And of course, that's not true. Expenses rise to exceed income.
Mm-hmm.
That's where a large part of America is at today.
Yeah. And it's like, so you can kind of combine those two. As you make more money, as you become more profitable, you enjoy more luxuries, those become necessities, and that drives this upward demand of having to have those things that you used to consider luxuries. And then add to it the amount of capital, the amount of credit that you can go out and get from third parties. And it becomes very easy to rely on other people's money in order to enjoy things that are beyond your means. And so Nelson talked, if we apply it explicitly to banking and the movement of money, it becomes clear that, you have to confront this every day. You have to remember to keep what you're going to spend underneath what you're earning. That sort of discipline is the only way you're going to accumulate the funds necessary to build capital in the first place. Now, the infinite banking concept is nothing but the best way to build capital. And in order to do that, you do have to build capital. And that requires not consuming all of your income, not spending it on everything out there that is available. And if you can have that kind of discipline and you can learn the best way to build capital, then you can prosper greatly. But you do have to get over the initial hurdle of having the discipline in the first place.
Yep. If you think about the work expands to meet the time envelope allowed, say this is the greatest concept ever. You did your vetting, you've done your research. It makes perfect sense. Or, and either take action or you don't take action, I'll put it off. Let me think about it for 90 days, or let me do another 6 months of research. All the research is going to be done at the end of that time period. My point is this. Yep, there's some unlearning. There's some learning. Education has to go on. Some research that you have to, but, once it's apparent, if you see what's going on, you'll know what to do. Get to it. And if you don't have the discipline to do it, you might as well dig a hole, throw yourself in there, have someone cover you up. I'm just saying that, trying to relate the time envelope allowed, you can put hey, maybe I'll start thinking about building capital. That's a great idea. I'll get serious with that, right after this event or that event or whatever is in your mind out into the future. You can put it out in the future as long as you want.
Mm-hmm.
Right. Well, when you get to that point in the future and you start thinking about it, you got to go through that whole process again. I think it's important because you are worth it. You are worth it. Your capital is worth it. So get to it. Do the investigation, do the research, do the learning, do the vetting, do what's required to make a reasonable and sound and logical decision, and then make the decision and go.
Mm-hmm.
Right? There's no magic in infinite banking. In order to build capital, you have to have discipline. But everything in life that is worthy and has value requires discipline. And this is no different. It takes discipline to do the wrong thing over and over and over. It just becomes a habit.
Right. Who was Willie Sutton?
So Willie Sutton was a bank robber, historical and notorious bank robber. And one time he was asked, Willie, why do you keep robbing banks? And he said, well, that's where they keep the money. So who's the biggest thief in the world today?
I'm going to take a guess and say it would be the Internal Revenue Service.
The IRS. How convenient. They create the problem, onerous taxation, and then they come up with a solution to the problem that they created, grant exceptions to the tax code. That's really the basis of a qualified plan, a tax qualified plan. Look, the IBC, infinite banking, is not an exception to the Internal Revenue Code. The income tax became permanent in 1913. The government was still trying to pay for the Spanish-American War. Think about that. 15 years later, life insurance predates the tax code.
Mm-hmm.
1913, life insurance has been around for 200 years. So life insurance cannot be a tax scheme. It predates the tax code.
Right. Yeah, life insurance in the U.S., it's been around for as long as the U.S. has been around. But the first life insurance policy was written in the late 1500s in England. This is like long before anything that is more popular in the financial world, the 401ks, 403bs, Roths, IRAs, what have you, mutual funds even. This is before all the financial derivatives, before the stock market. People who are building capital want a place to put money that's safe, and they want security. And I think a lot of the financial community gives the impression that the place to do that is with these tax qualified plans and in the stock market. Really, the safest place to put money in one of the safest industries in the world is an industry that's been around for centuries, and that's the life insurance world. So, when we talk about Willie Sutton's law, it's important to realize that where most of the money is where people are going to go to take it. And there's a lot of money in tax qualified plans. And a lot of money, people see their balances in these tax qualified plans in the stock market rise and fall, and sometimes pretty dramatically. But in life insurance, it doesn't happen. People don't lose money inside of a whole life insurance policy.
Right. Nelson points out that economic problems are best solved by people freely contracting with one another.
Mm-hmm. Yeah, you've talked about that before, that, who would you want to do business with? Who better to do business with than people who are seeking a safe place to put their money, who are on the foundation of caring for their loved ones.
Right. They love someone, they care for someone, they have someone's best interest in mind. Those are the kind of people that you want to do business with, but think about others. Life insurance is a dividend paying life insurance is a contract. We've talked about that. Free contract with other free people. That's very powerful.
What is the golden rule?
We all know and have heard the golden rule: do unto others as you would have them do unto you, which, we should absolutely recognize and honor that. But Nelson is talking about the golden rule. Those who have the gold make the rules. Right. And what's new in history? All of history.
Yeah, nothing new under the sun here. It comes down to a respect for capital when talking about gold, talking about capital, if you don't have respect for capital, then capital will go where it is respected. Nelson gives examples of international companies like Panasonic who had money in one country and the government there didn't respect it. And so Panasonic left and took their money where it was appreciated. The same, if we build that up into this rule that those who have the gold, those who have the capital make the rules, once respected, the people with the capital do make the rules. And most Americans don't have an explicit, intentional strategy to build capital. And so they must rely upon the capital of those who do, and those who have built capital. And so we overlook, so much of the non-monetary costs associated with depending on other people's capital. Just think of the last time you applied for a mortgage, or all the information, all the personal guarantees required when you apply for any kind of credit. We just give that away freely. And I've heard you say before that, often what happens before we lose money is that we lose control. Yet, when we go to get money, the first thing we give up is control in the form of a personal guarantee, a collateral assignment, agreeing to repayment schedules. That's just a claim on future income streams that we're freely giving away. And all of that has a cost. Now, you may not be able to wrap that up in a number, but it's a cost. You lose your job and you still have a bill payment due. What's the cost of that? What's going to be the harm, quantitatively speaking, in that case? It could be bankruptcy. It could be everything. So there's so much that we give up when we don't acknowledge that capital has value, that it must be respected, that we have to take responsibility for it. Because if we don't, we're going to give up the control to those who have that capital strategy. And when we talk about becoming your own banker and how the golden rule applies, becoming your own banker is just a process of practicing the fact that capital must be valued in your daily life. If you become your own banker, you're giving respect to capital. You're showing that it has value. You're planning intentionally to take advantage of the fact that capital has value. The golden rule has really become one of my personal just favorites in the book, because there is a sort of a higher level psychological, even like sort of almost metaphysical kind of respect that you have to have for capital that in the world of finance is just not given. So absolutely, I would encourage the reader and the viewer to make sure to pay attention to this section, because it drives a lot of the value, of the purpose behind why you'd want to become your own banker in the first place.
Very well said. I'd like to add that, we are not taught how to respect our capital, our money. So if we don't have respect for our capital, then we're beholden to that third-party lender who does respect capital, and therefore they have the ability and the discipline to accumulate it. Mm-hmm. Then, therefore, they have the ability to control your access, right? So it's the characters in the play that we're going to talk about probably later. We don't even know who the characters in the play are. And the character that performs the banking function, they're going to perform the banking function. That character exists. And we're not able to do that fundamentally because we don't have respect for capital. We don't have a systematic, a logical, a clear path, system, method, or strategy to accumulate the capital where we actually can control it. Then we're going to be beholden to someone else. I mean, that's the golden rule, right? Those who have the gold make the rules. And when you mention the other values, how do you value the non-monetary attributes? And I love the real estate investor, right? They typically I've got access to capital at this rate, right? They discount completely generally their time that they spent getting 2 years worth of income statements, a pro forma put together on their real estate portfolio, Then if the deal doesn't close within a timeline, you've got to cough up or adjust, create, recreate, or update your pro formas, and the deal's gone.
Right.
Potentially because they didn't have access to capital.
Mm-hmm.
You know, we have a tendency, look, if we don't respect our capital, most of the time we don't respect our time to the level that we put a value on our time.
Mm-hmm.
You know, when you practice the infinite banking concept, you really do begin to respect your capital in a more formal way, because you can see the accumulation, and then with the accumulation of capital, the opportunities appear. I know we've talked about that, and we're going to talk about it again, but the golden rule is very powerful, you know. It's like when you get to set your own rules, think about that. Wait a minute. I got to do what I want to do, when I want to do it. I got to go where I want to go, when I want to go. What is that worth?
Mm-hmm. And I know you've mentioned this before, that, you know, who cares what a credit score is? You know, the reason that a broad majority of the general public is fixated on this idea of a good credit score is because they don't have control of their own capital. And we've become accustomed to a system where we have to go to a third-party lender in order to get the money we need to live our lives the way we want. And you know, the lenders, they're not interested in you. They're not interested in your character. They want efficiency. They want to know whether or not they need to make the particular lending decision or on to the next one. And so they have a nice formal system that allows them to do that. And here we are in the financial world, jostling among one another and comparing our credit scores. It's a little perverse, you know, that this is, you know, we've disabused ourselves of the responsibility of accumulating capital, and then we compete with one another to see who has best access to what we've already given up. Yeah. It's a little sad, and it's something that we can reverse, and it's something that is available to everybody in becoming their own banker.
You know, you didn't say it, but I just envision dependency.
Absolutely.
You know, it's like I'm less dependent than you on the third party lender because my credit score's higher than yours. Or I'm going to pay less for my dependency than you're going to pay for your dependency because my credit score is higher.
Comparing costs of dependency.
That is very perverse. That would make a whole podcast.
That's something to reverse. Yeah.
What is the arrival syndrome?
The arrival syndrome is that state of mind where you know that everything else that there is to know. And a lot of people have arrived. Some don't know it. Nelson says that this is one of the biggest impediments to improvement. And it does, especially in the world of finance and in life insurance in particular, many people feel that they've arrived.
When someone knows all there is to know, you can't tell me anything. I have arrived. Mm-hmm. You know, I have found most people's understanding of life insurance is based on someone else's misconception. Everybody's had an uncle, a brother, a cousin that's sold life insurance. Yeah. I think the only license that I know of, that I can think of, that is easier to get than a life insurance license is an automobile driver's license. Right. When you walk into a room full of people, right, and you mention the word infinite banking concept or IBC, you are dang near the expert in the room.
Yeah.
Because no one else knows anything about it.
Right.
Unless they happen to have a life insurance license. And then they're the expert because they have a life insurance. I'm seriously. It's like, oh yeah, we can do that. Oh yeah. Or, oh, well, everybody knows you can borrow against cash value. There's no big deal. Blah, blah, blah. Mm-hmm. I think this has done, Nelson says, that this has done more limiting. This has been one of the greatest limitations to man's learning and understanding.
Yeah.
Is the arrival syndrome.
Yeah.
I already know.
And like you said, most people know that you can borrow against cash values, and they know about whole life if they're a licensed agent. But that's really not enough. There is a whole other world beyond that. I mean, if you read the book, you'll see there's so much more to it. It's not just about the product. It really kind of goes back with the idea that the infinite banking concept is not just about money, finance, or even the policies, the whole life policies. There's so much more to it, and so much more that the agent should know, and so much more that the individual should know. The book is becoming your own banker, not finding a different banker who reads a particular kind of book, and so that process of becoming your own banker involves moving beyond the kind of paradigm that's already out there in the financial world, in life insurance in particular. And in order to do that, you've got to be willing to accept that this other paradigm does exist, that there is a different way of thinking about things. I mean, to the person who observes the financial markets, who does everything right, who listens to the mainstream conventional advice, and it still blows up in their face, this should be a relief. This should be a good thing. It's not the case that even if you check all the boxes that everybody says you should check, that things can still go wrong. That doesn't make sense. It shouldn't make sense. And for the individual who practices their own banker, it doesn't. And so there's a big opportunity here. It's not just a criticism. It's not just saying that people get stale in their thinking, which we all do, natural human condition. It's an opportunity. It's an opportunity to realize that there's possibility out there to make sense of finance in a way that the mainstream, conventional financial advisors, the industry would otherwise have it.
Yeah, and that, no question, it's about the expansion of your thinking. When it comes to life insurance, it's getting past the idea of premium for death benefit.
Absolutely.
Nelson says that when they, I've heard him say that when they created life insurance, they misclassified it. It has more characteristics for banking than it does for life insurance. Mm-hmm. And that's really what, he has done in this book, is expand the thinking, just by observation, what's going on in the big wide world, in the business world, correctly classifying that, and then acting on it.
How do you explain use it or lose it?
Look, everything that we've been talking about, beating Parkinson's law, maintaining discipline, building capital, focusing on the volume instead of the rate, repaying loans at the market rate of interest. When it's applied to life insurance, you have to apply the knowledge. It's action, right? If you consider the law of use it or lose it. You tie your right hand behind your back for 6 months and then untie it in the 7th month. You tell me, are you going to be able to use your right hand?
Not very well.
No.
If at all.
And that's biblical too, the parable of the talents, right? If you buy high premium life insurance and you don't use it, you don't practice the infinite banking concept, you're just paying high premium life insurance. Now, if it's structured correctly and you're building capital, there's nothing wrong with that at all. Mm-hmm. But you'll wind up using it because opportunities will seek you out. They'll hunt you down. They'll track you down. They will appear.
Yeah. I think there's a psychological piece to this too. The information in becoming your own banker, the brain is a muscle. It functions as a muscle. And if you acquire this new way of thinking and it's not put into action, then you will lose it. And, if it's an idea that you don't have a full appreciation of and you lose it, then maybe it's neither here nor there to you.
Right.
But to those who have done it, and there's many people who are, losing what is essentially your own banking system is a big loss. There's a lot on the line here, in other words. And you do have to, in order to keep it, in order to grow, you do have to use that knowledge. And like you were getting into with the actual policy itself. You're going to be hit over the head left and right with all the financial noise out there about why in the world are you paying for high premium cash value life insurance?
They're going to hear, what's that agent's name? What company is that with? What are they rated? Are they any kin to this company or related to AIG or whatever? Why don't you look at the stock market? Why don't you look at gold? Why don't you look at real estate, foreign real estate? Mango farms in South America.
Buy a coffee farm in Bermuda. What are you doing?
Have you seen cryptocurrency? It's at a low. Now's the time to buy. Back up the truck. Anything, mainly it's whatever they're doing because they want validation of what they're doing.
Exactly. Right? Exactly. And, if you're not actively practicing becoming your own banker, taking out the policy loans, financing your own expenses through your own system, repaying with interest, and seeing the results that you bring about through your action in these policies, you'll give in eventually because it's relentless. The financial noise is relentless. Turn on, it's like being surrounded by CNBC. I don't know if we can say the name of the network, but if being surrounded by the financial noise out there, it can be stressful. It can be nerve-wracking. You have to stay committed. And the best way to do it is to utilize what you learn in the book, what you learn from an agent or a practitioner of the infinite banking concept who knows what they're doing, engaging, asking the questions you need to ask. If you don't make it a way of life, if you don't make becoming your own banker and being your own banker part of how you run your financial affairs, you'll lose all that there is to gain here in this book.
It sounds a little cultish whenever you say it has to be a way of life. I mean, am I going to have to move somewhere and do something? I'm just saying, look, it's an asset, right? It's a new asset. Well, just remember the first time you opened a checking account.
Yeah.
And you're probably a paperless guy. I don't know. You're young.
Absolutely.
Did you learn how to run a ledger on a check register?
I did.
Right. Okay. But it's a new asset. You have to learn to manage it. Mm-hmm. Right. Once you learned how to manage it, it's not a big deal. It's like and I'm not saying an automobile is an asset. I mean, it is. It's just a depreciating asset with a liability. Okay. Whenever you got your first automobile, it's a new responsibility. Mm-hmm. There's a new respect. Didn't you have to learn how to put the gas in, check the oil,
Absolutely.
You do check your oil, right?
I pay someone to do that. Yes.
Okay. The oil's checked. It's a new asset. You just have to learn to manage the asset and then master the asset. Mastery comes from use.
Absolutely. Absolutely. It is, just like I sometimes explain it to people like riding a bike. Mm-hmm. Most people have ridden a bike. Most people had no idea how to ride a bike before they actually knew. Yep. You can sit there and explain to someone how to ride a bike the best way all day, and none of that could matter, right? Straight over your head until you actually get on the bike and figure it out for yourself through practice, through use.
Right.
Yeah. Can you talk about the structure and the tax treatment of life insurance policies?
I can. The actuaries, they look at the historical data of how many people died at what age, and they use that data and those statistics, and then they use a theoretical lifespan of 100 years mm-hmm. to price this product called life insurance. If I die early, I'm going to get a death benefit. How do they charge that premium, to get the pricing structure of mm-hmm. the product? And Nelson points out when the life insurance companies created this product and called it life insurance, they misclassified it because it has more in common with banking than it does with life insurance. But, mm-hmm. The actuaries are nothing but professional bean counters. Right? Mm-hmm. It's like they know exactly how many 50-year-old females are going to die next year. Yeah. How many 42-year-old males are going to die 3 years from now. Pardon the pun, they're deadly accurate. I mean, they are. They're extremely accurate.
Yeah.
But so you got to price the product, and that's really how they did it. The historical data, statistics, and put this thing together, but they just misclassified it
Mm-hmm.
because they focused on the death benefit, which is what they were pricing for.
Mm-hmm. And Nelson gets into, given that structure, talks about the tax treatment. And of course, life insurance in general is mostly a tax-free sort of asset. That death benefit is the replacement of a loss, not income per se to the beneficiary. And so it's not taxed as income. But there is, time has gone on and, Congress will try to kill anything good. And sure enough, they did try it with dividend paying whole life. There are some restrictions. People will say, if you really explain the power of becoming your own banker and dividend paying whole life, they may ask, is this too good to be true? Like, really, is this legal? And yes, it absolutely is. In fact, in the software that's used to build these policies, there's IRS guidelines baked right in there. Like, they know. And in the 80s, there were some hearings on these policies. The transcripts are available online. The videos are available online. Pretty gruesome, and they're out there for anybody who wants to watch them. And so some restrictions were placed on these types of policies, but, dividend paying whole life is so good they couldn't kill it. And so even though there's some restrictions, you absolutely can still use dividend paying whole life to become your own banker. And you can do so according to the rules they lay out. What we want to avoid is violating what rules that do exist, and whatever our opinions about the IRS or Congress or whatever aside, we definitely don't want to violate those rules, and we don't have to. But if we did, then these policies that are life insurance policies would be they'd be called modified endowment contracts. And we don't want that. We can get technical about it, but basically what it means is that if a policy is identified as a modified endowment contract, then it becomes taxed like a tax qualified plan or an annuity would be. The buildup would be taxed. The tax treatment on loans would be on a first out basis. So the money that is taken from the policy first would be treated as taxable income. And we could go on, but the point is we can avoid all that. And we do. It's someone who knows what they're doing, a practitioner who understands infinite banking and understands these policies, can build one that is in accordance with, adheres to the IRS guidelines without violating them.
All right. If life insurance was misclassified and has more characteristics for banking than life insurance, then the goal would be to put as much premium as possible into the policy, right? And maybe the least amount of death benefit. And so that creates an incredible capital machine when you do that. And so in the 80s, when you spoke about them, the IRS, or actually the Senate, held hearings in the 80s that tried to kill it, just like you said, but couldn't. I love that. But they did put limits, right? And the limits, there has to be a relationship between the death benefit, the cash value, and the premium. And if you cross these limits that they've laid out very clearly, then it is reclassified as a modified endowment contract, and it changes the tax treatment. It's not the end of the world, but if you're young, by all means, it's very easy to avoid a policy becoming a MEC. Once a policy becomes a MEC, it can never be unmEC'd. So if you can avoid it, you want to avoid it. And really, Congress was looking at life insurance, and they, in almost an accusatory way, saying, "Oh, this is a tax scheme. This is a tax dodge. You're taking advantage of a loophole in the tax law," which is ridiculous. Life insurance preceded the tax code. It can't be a tax scheme. And it wasn't even really happening. People weren't, which is a common story or noise that you hear. Oh, well, people were abusing life insurance. Not true. And I think if you read the transcripts or watch and listen to the hearings, I think the viewer, the listener would probably agree that the attack on life insurance was not because it was a tax loophole. It was because of, multi-level marketing term providers like A.L. Williams in collusion with the senators that sat on the committees and chaired the committees. But that's my opinion that should be set aside. The limitations are there, clearly avoidable. And so we're not trying to you don't even have to try to make a tax scheme out of it. Right.
And that's something important to point out, and a question that we get sometimes is that, can I get a tax deduction on my premiums? Well, no, and you shouldn't want one. A tax deduction isn't a tax elimination. It's just a tax in the future.
Tax deferral.
So
if I structured it where I got a tax deduction today, then I would be experiencing taxable distributions or withdrawals in the future. Okay, well, tell me, what is the tax bracket going to be in the future?
Good question.
Yeah, I don't know either, right? And neither does the IRS, but I know what their preference would be.
You can take a guess at the direction.
Right. Would you rather pay taxes in a known bracket or an unknown bracket?
I'll take known all day.
Okay. Now, how many times would you like to pay taxes on it?
Please, only once.
Right. It's so after tax dollars, private contract, complete control, and just let me finance what I was going to purchase anyway. Right. Let me use my God-given abilities and talents to be creative and finance that.
Yeah. So, you get the tax out of the way. The tax man, it couldn't be that life insurance is a tax scheme because the IRS gets paid. Uncle Sam's getting paid. They got paid when you made the income, but that's all they need to get paid. And everything after the fact that involves your capital system should be on the most favorable tax basis possible. Another objection that I think relates to this section here is, some people say life insurance. I don't want life insurance. What? I know life insurance people. My uncle's aunt's second cousin twice removed got screwed by some agent at some point in time, and therefore all life insurance agents are to be hated and avoided. And I used to get sort of anxious about that objection, and people would say, "Oh, it's life insurance. I can't touch life insurance." And then it occurred to me one day, no, we should be thankful that this is built in life insurance. Life insurance is the best. Life insurance has the best tax treatment of any financial asset in the world. What better place to put money than in the best tax-treated asset out there?
That's an understanding based on someone else's misconception. It's a perfect example. It's like, it's third rail, don't touch third rail.
What is universal and variable life? Are they good policies for becoming your own banker?
No, absolutely not. And you have to consider the structure of the policies. Universal life is an unbundled product. The life insurance industry and companies separated the death benefit from the savings component, okay, for clarity. Well, now let's look at what's really going on. Universal life was created in the 80s when interest rates were very high. So the savings component could illustrate very well. All right. Now, the death benefit component, there's a cost to the death benefits, cost of insurance, which increases every year. Every year that you have a birthday, you're getting closer and closer to mortality. A guaranteed expense to the life insurance company. So the closer you get to mortality, the cost of the insurance is greater and greater.
Right.
Okay. Well, what have interest rates done since the 80s?
Went south.
They went south. So now that segregated savings component doesn't look as good, doesn't illustrate as well. Right. Well, the cost of the insurance keeps going up. Okay. Those policies have all but imploded. Here we are in 2018. And if you've been in the life insurance industry, you know that. If you've been an owner of Universal Life, you've experienced that. So what happens in the 90s? Okay, interest rates have come down in the 80s. Well, the markets are going like gangbusters in the 90s, right? Except for a couple of years. So the life insurance companies replaced that savings component with the variable universal life product. They came out with that. All they did was change the savings component from a savings vehicle or an interest earning account with essentially mini mutual funds or sub accounts within the variable universal life insurance policy. I mean, you can have a long-term growth stock mutual fund, fixed, balanced, blended account, sub accounts, right? And that variable universal life product is an investment product. Okay. All right. Well, the cost of the insurance continues to go up. The market values, the account values go up and down, right? Well, what is the market going to be whenever you die?
Good. That's a really good question.
Yeah, you don't even know when you're going to die, do you?
Nope.
Neither do the actuaries. That's really God's business, not even any of your business. Okay. The markets, are the markets. They're going to go up and down. But there's a cost to the sub-accounts, and there's an internal increasing cost of the insurance that continues to go up. Those policies cannibalize themselves too over time, because if the market rate of return that is credited to the policy owner doesn't outperform the increasing cost of the insurance, that policy is going to cannibalize.
Yeah.
So the policy owner is going to have to pay a higher premium, or potentially they'll have the opportunity to lower their death benefit because the cost, right? Okay. Well, strike one, the insurance companies got it wrong in the 80s with universal life. They got it wrong again in the 90s with variable universal life. And now here we are in 2018. They've got it wrong again. Strike three with the equity indexed universal life policies. Right? Most of them have dropped the E, and now they just call it indexed universal life. So without being too technical, the money's not actually in the market. It's not an investment. It's still a fixed product, but they use indices, right? And then the salesman typically says something like, well, but you can't lose money.
Right.
Okay. Well, yes, that's true. You can't lose money in the index, because if the index goes zero or past zero, then there's just no interest credited on that savings component. Okay. Well, that implies that these indices are going to go up forever, or in a linear fashion anyway, right? In which they don't. Okay. And then too, there's not only a floor of zero, there's a cap on what can be credited. And then they have caps and spreads, so the cap may be 10, 11, or 12, or 14, whatever it is. And the spread may be, well, the insurance company is not crediting the policy owner for the first 5% return of the index, but they get credited the next 5%. All of which, the caps and the spreads, are contractually retained by the insurance company. The cap and the spread amounts, the insurance companies can raise or lower the caps. They can raise or lower the spreads. Okay.
Yeah.
The cost of the insurance continues to go up. All right. And then it hits that vertical curve in the late 60s and the 70s, unless those indices have outperformed and compensated for the increasing cost of the insurance, those policies will cannibalize as well. Okay. So universal life violates the very essence of insurance. With insurance, I'm paying a premium to offset a risk to the insurance company. With universal life, the policy owner retains the risk of the death benefit being in force at natural mortality. They're flawed by design. You cannot correct the design.
Yeah. When I talk to people about these policies, the whole point of becoming your own banker is to build capital that's under your control and secure. That's the whole point at the end of the day. And you're going to manage your cash flow through it. You'll finance the things you're going to finance otherwise anyway. But the initial starting point is that you want the cash value to be secure. Well, as soon as you unbundle it and add the fancy names, universal, variable universal, equity index universal, index universal. We know we can paper people over with terminology all day, but at the end of the day, what you're doing is exposing your cash value to loss. That's all you're doing.
To the risk of loss. That's right.
It defeats the entire purpose. And you can guess all day about interest rates. We can assume great ones in the 80s. We can say things will get better than they are now in later years. And who knows? Like you say, nobody has any. We don't have control over the markets. The insurance company doesn't have control over markets. Interest rates included. So. Yeah, but what we do know will happen is that there will be a rising cost of insurance. That you can be sure of, and just like you said, the later you get in life, the higher that marginal increase in cost becomes. So why risk it? If it's important to point out too, and we talked about how life insurance predates the tax code, predates a lot of the financial industry. It certainly predates universal and variable life. That these are 30, 40-year-old concepts. Whole life insurance is, 300-400 years old. Like, there's no comparison, and there's no reason to complicate things. And we've talked about this before, is that we always want to make things complicated. Something is simple, we got to complicate it. And the concept of dividend paying whole life, once you learn how to ride the bike, is simple. You don't have to add all the extra gears and the bells and whistles to make it better. It's just not necessary. And it, in fact, defeats the purpose, like you say, of insurance, but also the purpose of becoming your own banker.
I'm glad you use the terminology paper over. All right. Good. When you look at a universal life insurance policy illustration, and we can talk about illustrations and projections at another time, they're about 40 or 50 pages. A dividend paying whole life insurance illustration is, 12 to 18 pages. All right. But beyond that, when you look at a contract, the life insurance policy is a contract. Right? Okay. There's provisions in the contract. I encourage my clients to consider 2 sections of the contract, right? Expressly. If you don't read it, you don't want to read it. I understand it's written by attorneys and lawyers, and most of the time contracts are meant to not be read.
Right.
Okay. When you look at the loan provision, we're talking about becoming your own banker.
Mm-hmm.
All right. So there's contractual rights that the policy owner has and retains. Look at the loan provision of a universal life policy and compare that to the loan provision of a dividend paying whole life policy. One will be about 1.5 pages, maybe 2. Mm-hmm. The other one will be about 6 or 7 pages. Okay. Now, if we're looking at provisions of the contract, I would also encourage my clients to look at, become familiar with, and actually be very familiar with the paid up additions rider provision. Mm-hmm. Because we're talking about accumulating capital,
right?
And we're talking about accumulating a lot of that capital in a paid up additions rider. Mm-hmm. And then we're talking about becoming your own banker, leveraging that capital through loans. Right. So those 2 provisions become pretty important. And when you compare the 2 provisions against, dividend paying life insurance, whole life issued by a mutual company, compare that to a stock company's universal life policy, their provisions, looks like a duck, quacks like a duck, has web feet might be a duck. I digress a little. But then, and too, the reader, the listener will, in the financial world, you mentioned it earlier, we're surrounded by noise, some of the most egregious noises in the financial world. And it's part of that noise is coming from the, financial guru. All right. Absolutely. And also let me say that the universal life illustrations, they illustrate beautifully. Of course, they're non-guaranteed. The dividend's non-guaranteed as well in a dividend-paying policy, but you have 100-year history or more of dividend history. Yeah, they're not guaranteed. Well, look, your company can't guarantee, and the dividends come from the experience or the profits of the company.
Mm-hmm.
Okay. Your company, my company, your company, even though you were profitable for the last 50 years, doesn't mean you can guarantee your profitability in the 51st year.
Mm-hmm.
And even if you could guarantee the profitability or that you would be profitable, you can't guarantee how profitable you will be. Neither can the insurance company. Okay. So I'm just saying there's some non-guaranteed elements in both illustrations. The universal life policy, it was only restricted a couple of years ago through the NAIC, the National Association of Insurance Commissioners, restricted what kind of a rate you could illustrate on a universal life policy. Okay. There's some things to consider. Nelson only talks about universal life and variable life. He gives you the history, and he talks about, I think he dedicates about a page and a half to it.
Yep.
But there's more that the consumer should consider and understand about universal life policies because of the noise that they hear in the financial world.
What stands out to you from part 2?
I think what stands out to me in part 2 the most is how important the human factors really are, as simple as they seem. Because if you can get past the human factors, the rest is ridiculously simple. It is so simple. I'm not saying it's not hard, to unlearn some things and to properly classify what's really going on. There might be a challenge or two there, but the infinite banking concept is ridiculously simple. All you need is a well-run mutual company, a properly structured dividend-paying whole life insurance policy issued by one of those well-run mutual companies. And then you just need to learn how to use it to perform that banking function in your life as it relates to your needs. And learning is very, very easy. You'll get that through application, right? Through the use of it. Go finance your first car, credit card, set up the loan repayment, take the loan, set up the loan repayment, direct the money to the PUA, the market rate of interest. It is very simple. Then you just add velocity to it, right? Do it more and more and more and more. What you were going to finance anyway, just use it.
Yeah. I think what stands out to me is the focus on capital. I mentioned earlier that the golden rule is one of my favorite parts of the psychological factors. And, at times it can be, you have to pay attention to where Nelson is placing these parts throughout the book. There is intention behind it. And upon reading and rereading Becoming Your Own Banker, it becomes apparent that a focus, especially in the golden rule, but throughout the psychological factors, is laying importance on the idea of building capital. And most people don't have a strategy to do that. They've never even considered that capital is a particular kind of thing that they could strategize in order to build. Therefore, this entire concept of using a capital system, an entity in which you've built capital, is foreign. But if you do pay attention to capital, if you do respect it, if you take personal responsibility for building it and accumulating it, then you can retain so much of the control that we're so used to delegating out. The entire system that we've become accustomed to in the financial world as a result of delegating that control is really perverse, and it doesn't have to be that way. Like you said, the psychological factors are so important. Infinite banking is not just about money. It's not just about finance or even dividend paying whole life. There's a psychological component, a spiritual component. At a very high level, it's about living life in a different fashion. And if you can do that, like you say, if you can get through the psychological holdups, those which are natural features to the human condition, we all have them. Everybody's got to beat Parkinson's law every day. You have to respect capital, take responsibility for building it. You've got to use the knowledge that you acquire in the book and from your practitioner, whoever you're working with these policies, and exercise it. You have to work your system in order to reap the benefits. But if you can do it, man, you know, it's just like riding a bike. You can get somewhere a lot faster than you can walking.
Right.